So welcome back to the podcast. This is the financial planning edition for April 2024, and I'm joined by Benjamin Klein.
Thanks for having me once again. Number two.
Yeah. So we got some really good feedback. So first of all, please share any questions and comments on YouTube. Obviously, subscribe and follow our podcast, but we'd love to answer your financial planning questions, whatever questions you have, whether it's about stocks or the market or financial planning. And definitely clients, of course, reach out to us and we'll cover them over the coming the podcast. So we plan to do a financial planning one once a month. And so we'll go from there. So today we want to talk about the debacle of these bare trusts. And, we'll explain what we were talking about. But a few weeks ago, we were getting calls from clients and accountants for those that have joint accounts with their adult children, or those that have joint accounts with or in trust for accounts with their younger children, as well, wanting to know if they were subject to new taxation rules. And we want to talk about why these accounts got open, the rationale for them, and talk about if it's right for you. So, Benjamin, why don't you explain? I'm going to give you I'm going to hand over the hard stuff to you. Explain a little bit what the heck a bare trust is, and we'll go from there.
Okay, so debacle is the right term. So, probably not everybody's heard about this, but essentially the CRA came out in the last year and said that if you have, in layman's terms, essentially an account where the assets inside are not all owned by the people on the account. Yeah. So a good example, as you mentioned, is an account. Maybe you have two parents or one parent and they have an adult children or multiple adult children on that account. Mm-hmm. The assets are not really owned by the kids in most cases.
Yeah.
They're owned by the parents, and the child is added, or children are added to the account as an estate planning tool in preparation for, maybe the parents are getting older, they might not be able to make decisions or manage the account anymore.
These things were set up to assist. So we all have aging parents, and as our parents age, especially maybe there's only one of your parents passes away, for God forbid, the adult children want to protect the parents' accounts, and also for probate purposes as well. It could avoid, it's hard to avoid in life death taxes and market volatility, but for probate, there's a potential that you could avoid that if adult children are, of course, always contact your lawyer, but that's one of the reasons why these things were set up.
Yeah, exactly. Mm-hmm. So this was extremely common. We had a lot of clients do that. My grandmother did it when she was getting older. So she added my mom and my uncle, mm-hmm. and this was very, very common for older clients, older investors, particularly if their spouse had already died or if they're single for some other reason. Mm-hmm. And again, the point was, number one, to ensure the continuity of the account. So as an example, if you have a non-registered account and the owner dies, it goes through probate. People probably have heard of that. What it really means is you have a will, and the will dictates what happens to, among other things, a non-registered investment account. Things like RSPs, TFSAs, they go outside probate, so they're not governed by that. But if you have a non-registered account, that is governed by the will. So the government, essentially, courts, have to dictate whether the will is valid. For example, let's say that you have a will that doesn't give anything to your spouse. Well, that's not legal. In Canada, you have matrimonial property rules. You have to leave something to them. That's the kind of thing that could be contested to make sure that it's really what the person who died wants, and also that, again, as in this example,
obviously makes sense. Yeah.
Yeah. So the spouse would, have to get something. So that, of course, there are lots of other reasons. But basically what happens in practice, assuming that the will's in good order, is even if the will is very straightforward, the money can be locked up for easily 6 to 12 months, sometimes longer. It can be very difficult to take money out, even for needed expenses. Yeah. For things like, say, funeral costs, lawyers' fees.
To do your final tax return to pay for that.
Even to make, say, charitable contributions that are in the will. You need to get approval from the bank. You need to get all kinds of, it's just a headache, quite honestly.
So there's someone actually at Revenue Canada or somewhere in the government that reviews the will against your account.
Yeah, it's the probate courts who decide that kind of thing. Mm-hmm. And so again, it's just a pain in the head. It's a pain in the head. It's a pain in everything. And
this is a family friendly
exactly.
podcast. So
what the idea behind adding usually an adult child, but it can be somebody else too, to the account is when the parent or the parents pass away, there's still an owner on the account, and they still have control, which means number one, doesn't get frozen for that 6 to 12 months, and number two, it actually doesn't go through probate at all because the account is still active, still has an owner. We have what's called usually this is set up with what's called joint with rights of survivorship, meaning that when somebody passes away, that share of the account is just given directly to the remaining owner or owners. So you also avoid probate fees, probate taxes. They're called lots of different things. They're actually called estate administration fees in Ontario.
And we believe probate is about 1.5% of the value in Ontario.
Yeah.
Okay. Obviously different in different provinces.
Correct.
And if you're in the US, of course, don't listen to us.
Totally different.
Totally different.
You should skip this part. Okay. But Ontario, it's 1.5%, which is really not nothing. Say you have $1 million account, it's $15,000 down the drain.
Down the drain, whereas you could have just gone to maybe spoken to your lawyer, spoken to your accountant, and then your portfolio manager or your broker would set this up at essentially no cost to you. If it makes sense.
So another benefit is right there. It's very, very inexpensive. You're just opening a new investment account. That's really all there is to it. So back to the main topic, this bare trust debacle. So in the last year, CRA has said that these kinds of accounts, jointly owned accounts, where not every owner is a true owner of the assets, is what's called a bare trust.
Barry with my kids is now not Barry's assets, it's a trust.
Right. Yeah, so it's called a bare trust, and you have to file a new tax return. You have to file a T3. That's what trusts file. This was very poorly communicated by CRA. I think, in fact, I'm sure a ton of people who are affected by this probably didn't know at all.
No.
Hopefully their accountants knew, but they didn't know at all. There was not a lot of time or guidance given, and if you Google this, you'll see a lot of articles. Some of the guidance was completely contradictory. For example, you had to, I think this was in the Globe and Mail article about it, you had to provide the trust document that was used to set up a bare trust. Basically, all of these accounts were set up without trust documents because they weren't trusts. So it was just really poorly.
You have to have a settlor, a settlee, whatever those things are called, and full trust document, and have gone through a lawyer to spend, setting up trusts are not cheap.
Not cheap, not easy. There's a lot of work involved. They're really not trivial. So anyway, the CRA did come out, I think on March 27th, March 28th, sometime around there, a few days before the tax filing deadline. The tax filing deadline for trusts is earlier than for people. And they said, okay, this year, not required. I'm sure many people have already done it. That was another complaint that came out. This is punishing.
People spent the money with a lawyer and their accountant on getting this stuff done.
Punishing people who did it properly and were ahead of the game, and not super fair to them. But anyway, they decided there were not going to be T3 requirements for this year. And presumably it will come back up next year, and probably you'll have to do those kinds of things.
Presumably, but there was no guidance given in the communication by CRA to accountants or to the
So really not intelligently structured or guided or laid out. So we thought this would be a good idea to talk about why these were set up in the first place, what the benefits are. So we touched on them a little bit earlier, but particularly for aging parents, adult children, that kind of thing, it's very common to set up these joint accounts. And again, this may change as the guidance comes out. So certainly 6 months from now, this might be outdated, but for now, the idea was really, again, avoid probate, maintain ownership and control of the account, and set it up in such a way that it's kind of frictionless or as little friction as possible when the parents do pass away.
That's right. And as we get older, there's no question our mental faculties may decline, and it may make sense for those to have their adult children assisting with the finances, assisting with the portfolio management. So these things are important and things you must consider as part of your estate plan. It may make sense for you if you have a significant amount of money, if you're the single surviving spouse, to look at setting up an actual formal trust.
Yep.
There are formal trusts that exist. One's called an alter ego trust or a testamentary trust. These things, of course, are very expensive to set up. A separate tax return that you must do every year, as Ben mentioned, so you have to weigh the pros and cons.
Yep.
But we've had a number of clients set those up, those that have significant assets. People set them up because they're worried about maybe bad actors getting access to their parents' money, right? So your father is still alive, your mother's passed away. Maybe there's a girlfriend that comes into the picture. We're not quite sure if we don't want her to have access to that money. So those are the reasons why some people look to set those formal trusts up.
Yeah.
And there's also, Ben, we didn't talk about the informal trusts that people set up with their children, right? People get, there's inheritances that your children may receive under the age of 18, gifts that they may get, and you want to put it to work. You want your children to learn about investing, and then all of a sudden it becomes a formal trust. So there's lots of different vehicles that people need to explore and talk to their financial planner, portfolio manager, accountant to see what's right for them. And we're always happy to talk to you about them if it makes sense.
Yeah. So I think it would be a good idea to just briefly talk about all of those. So because you mentioned it earlier, the potential downsides of doing this, of letting people have control of the account that you don't necessarily want them to. This is one thing that I always tell clients is, if you're thinking about, say, adding your adult kids to your account, and if they're interested in the idea, I say, presumably you wouldn't be interested in the idea if you didn't trust your kids.
Yes.
And of course, this is maybe the most important single thing to do. We have been lucky that at least to my knowledge, we haven't had any issues where clients have, say, added one of their kids to the account and then there was some skullduggery.
Yeah, that's a good word.
I'm sure it's happened.
It could happen, right? Where what issues could arise when you have one of the adult children calling up and saying, "Send me the money," or because it's my money, I'm on the account, or let's get rid of all these these blue chip stocks, and I'm telling you to buy cannabis and all Nvidia and go crazy, right? Yeah. So those are risks.
So that's exactly the issue. They become a legal owner.
Yeah.
They have the ability to give instructions. I mean, of course, in a business like ours, we know our clients really well. We're not just going to say, okay, sure.
Yeah.
But it's, it could go to court, and they have just as much right to give instructions over those investments as anybody else.
Yeah. So that's a risk. Also, one of the things that is what happens if your children get divorced.
Yeah.
An adult child is now owner of the account. They've been on the account for a number of years. The portfolio's gone up in value, and then all of a sudden there's a separation or divorce.
Yeah, complicated.
Complicated.
That's why you have a lawyer, and that's why you talk to somebody
Life isn't easy.
knows.
Okay, so
exactly.
Go ahead. I cut you off. Yeah.
So back to the different kinds of accounts. So again, this kind of joint account with adult kids, very, very common. But we also have a lot of clients, and I get a lot of questions about, I want to give some money to my kids without kind of separate from this bare trust situation, or even to grandkids. And what's the best way to do it? So there are a few different ways you can do it. Probably the best known one, I guess, is a formal trust. And when you set up a formal trust, it's kind of like setting up a corporation. It's setting up a new entity. It's kind of like a person in the eyes of the taxation and laws. And that means, like we talked about, you have a trust document, you have to pay a lawyer to set it up. You have to have annual tax filings because, again, it's an entity that has assets. That, of course, costs money, not free. And you essentially have complete control over how this money is distributed to the beneficiaries of the trust over time, at what age. So, you often see this sometimes from a will. Maybe a grandparent wants to leave some money to a grandkid. They'll set up a trust, particularly if they're not the age of majority. Yeah. But sometimes even if they are the age of majority.
We haven't seen too many of these formal trusts be set up.
A few, but not many. In my view, and I'm sure some people would have a different opinion, particularly if you're a trust lawyer, it only makes sense you have enough money for it. Yeah. If you want to give your kids, say, $5,000, the cost of setting up the trust and the annual tax filing is probably not really worth it. If it's a much bigger number, definitely an option.
I think you're right. The dollar figure matters. Also, if there's some family issues, where you're maybe trying to avoid giving money to the parents, or you're worried about the capabilities of the grandchild in the future, their ability to handle money for whatever reason.
Yeah. So lots of different reasons that makes sense. There are also less expensive ways of setting up similar things. So one is called an informal trust, which we've talked about a lot. These are sometimes called in trust for accounts, which are basically, they don't have formal is maybe the right word, trust documents, but they do have some kind of documentation basically saying this account is being managed for the benefit of somebody else. This person, often this person is not the age of majority. And in fact, there can be some mechanisms where when the beneficiary becomes age of majority, you can convert it into they basically take the money and do whatever.
This is what I have for my children. They've got some gifts. They both had bar mitzvahs. There was money that they got. We invested it. One of my older son, Abe, is now, he's going to be 20 years old this year. Oh my God. So we've converted that informal trust to his name. We put money into a TFSA for him. My other son is not 18, so it's in this informal trust at the moment. At age 18, you'll probably give me advice to convert it to an account in his name, but me overseeing it, because I don't want him to have access to all that money at age 18. I want him maybe to know about it a little bit, but not really know about all the money that's in there.
So you're pointing us exactly in the direction of the next point, which is that you can see that there's a spectrum here of the different options that you have. In a formal trust, you can say the beneficiary doesn't get to touch it till they're 25 or even 30. And that's how it's set up. There's no kind of pushback on that. In an trust for, it's a little bit grayer in terms of how it typically gets managed, and we see this happen very, very frequently. There's a little bit of a tax benefit to it, and one thing I should note too is that for both of these types of accounts, the money that's put into the trust or the informal trust is irrevocable. You can't take it back. And this has been, this is held up in court. There have been in trust for set up for beneficiaries, and the parents or whoever put the money in the account in the first place said, I kind of need that money back. And
well, so they kind of have to ask their adult child at the time to give them back the money.
And it's happened that they didn't have permission to do that, and they got sued and they lost because it was an irrevocable gift.
Yeah, you don't really want to get into lawsuits with your family. That's not fun. Okay.
I don't think with anybody, but definitely not with
definitely not family. Yeah.
So one other benefit here is you actually do get a small tax benefit from setting up. So formal trust, you don't own any of the assets; it's owned by the trust, so it can be a tax benefit or a tax.
Correct.
Tax
so it may be tax. So if you have a high tax rate, the money's taxed in your personal hands. Now it's taxed in the trust hand. The trust probably doesn't have any T4 employment income. The income is only dividends, interest, and capital gains, probably a much lower tax rate and that's the reason to set those up.
So trusts usually actually pay higher tax rates. Trusts are usually taxed at the highest rate, but there are different ways that it works out in terms of income being distributed to the beneficiaries, paid in their hands, et cetera. So, don't need to go into all those details.
We're going to get into those on topics in the future.
So, and in trust for it, you kind of get the small benefit of interest and dividends are still taxed in your hands, but capital gains are taxed in the hands of the beneficiary. Even if they're a minor, by the way. Not everybody knows that minors can and are supposed to file tax returns, even if they only have a little bit of income. And so the benefit there is, if you buy things like, say, non-dividend paying stocks or other things that have mostly capital gains, you get to pass on some of those taxes to the kids and save a little bit of tax.
Beautiful.
There are other, even less formal ways. We kind of, in the jargon in the firm, we call them for accounts, where basically you just set up an account, an investment account. You have like a designation in the title of the account, Benjamin Klein for whoever, for my son or for my daughter. It's still my money. I still have full control over it. It really is just a name in my account, but you have a designation to kind of keep it separate. You can take it back at any time. You can shift it around at any time.
Are those common?
Very common. We have lots of those. And the benefit is it's easy to track. It's separate. You still have the money there. Another benefit is you still have full control. You haven't given anything away that you can't take back if you don't want to. But there are no tax benefits. It's also very inexpensive. An informal trust, just to go back to the previous point, also very inexpensive to set up. Essentially the same cost as just setting up a new investment account.
There should be no
which
cost.
Almost zero in many cases. And same thing for a for account. You're just opening a new investment account. That's all. Has a slightly different name to the account, but that's also very common. And I would say probably even more common than in trust fors right now. But of course, it depends on each person's individual situation.
That's right.
So lots of different options here of different ways to set it up.
Does size matter? How much money you're putting into the trust to really make it a difference? Whether in trust for the for account, the formal trust.
I think yes. I think it's just like the different benefits and detriments that you get from each different account depends on the magnitude of those benefits or detriments depends on how much money you put in.
Yeah.
You say that a wealthy grandparent dies and they want to leave $500,000 to their grandkids. That would be nice.
Yeah.
That's probably something that should be handled through a formal trust. There's going to be significant income earned inside the trust. Maybe they do want to have a trustee, in fact, in charge of the money and make sure that it's spent wisely and prudently and and invested properly. On again, going back to like a $5,000 gift, the cost of setting that up probably doesn't make it worth it. And the tax benefits too are not really hugely significant in that case.
So I'll talk about an example that we had, Ben, where we had two granddaughters who the grandmother passed away and they both got $300,000. Which is
that's nice.
Nice chunk of money. So we left it in. I mean, the decision was to keep it in an in trust for account, not set up a formal trust. And through good investing and through compounding, these are now worth $1.5 million. Right? To get the money when you're 2-3 years old. Now you're 20 years old. So what the parents decided is they're going to stay joint on the account with the children. They want to make sure that they don't, that the family has full understanding and following, and maybe the parents could also make decisions on the portfolio as well. A lot of our clients, when there are inheritances for their kids or there's gifts, they really don't want the 18-year-olds, as I talked about, to know when there's that large sums of money. How do you get around that? And of course, as a portfolio manager, we have to know our clients. We have to do our know your client or regulatory requirements for each client. And even if you're 18, you're an adult, and so it requires a meeting and full knowledge of the owner of the account to discuss the portfolio with their portfolio manager. It's tricky.
Yeah, there are a lot of softer issues that come up with this kind of thing in terms of family dynamics and in terms of the readiness or capability of, say, an adult child to be able to handle this kind of money.
Yeah.
I don't know. I won't speak for you, but maybe for myself, I don't know what I would. I don't think I would have done anything too stupid. But at 18, I didn't even know what I wanted to do for a living. I would have had no idea.
But if you heard you had $1.3 or $1.5 million, you say, "Holy smokes, I'm going to buy a Ferrari."
Yeah.
And that kind of defeats the whole purpose, because your parents, your grandparents probably want you to use that for one day, a house purchase, a down payment on a condo, maybe to start a business, not something ridiculous. Right? Yeah.
And it's interesting because on the other side of the same coin, you have sometimes an elderly grandparent, elderly parents, that kind of thing. They don't want to feel like they're controlling from beyond the grave. Yeah, exactly. I've had someone use that exact term for me. So they're
give with warm hands instead of cold hands. We hear that all the time.
Pre early inheritances. There are lots of kind of different fuzzy ways you can do this, and want to make sure everybody feels good.
People want their
valued.
Want their kids to learn about investing. The problem is they're minors, so they're not technically allowed to give you or me instructions about how, my 17-year-old son, he is taking business stuff in school, and he's on the investment committee of his school, and he says some of his friends' parents have set up simple accounts to do trading. I'm like, you can't do that with me.
Yeah.
That's not happening. But but I do want him to get involved in investing, but he can't give me instructions on how to invest his money. It's an trust for account. A few questions, because this is an interesting topic. You're a grandparent. You want to give money to your grandkids, $10,000, $15,000, whatever it is. Would you set up the trust for in your name as the grandparent for the grandchild, or do you set it up in the parent's name?
That's a great question.
Yeah.
So to be clear, I am not a grandparent.
This is theoretically,
a hypothetical situation. It's a very good question.
Yeah.
Again, this kind of comes back to family dynamics.
Yeah.
Hopefully, you have a great relationship with your kids and grandkids,
Yeah.
and you'll tell your kids, the parents, that you want to do this, and they'll say, "Fantastic! I'll set it up in our, give it to us. We'll set it up in our name." And of course, there will be no skullduggery in this situation either. And Bob's your uncle. The complicated thing is if you maybe don't even want the parents to know, or there's some other complicating factor. Of course, if you're a grandparent, you're by definition a little bit older, and you want to make sure that what happens if you die?
If you passed away while the child was still a minor and it's in an trust for or whatever those type of accounts, there could be an issue there too, right? So it's always probably best, obviously talk to your lawyer and accountant, but to put it in the parent's name, not the grandparent's name.
Yeah, that would be ideal. But
same with an uncle or an aunt. The uncle may not have children of his own, wants to give gifts of meaningful size. It's tricky because if I write the check to my sister, my brother to put it into the kids, do I really know that the money's going to go into the trust for account?
Yeah, exactly. That's there is a level of trust, no pun intended, that goes on here, and I would say, in again, this is of course not legal or accounting advice, but in that kind of situation where there is a concern about whether the money is going to be used as it was intended for, that's probably the kind of thing that a formal trust comes into play with, where there is legal protection on the assets, and, the will dictates exactly how the assets are supposed to be handled and for whose benefit, et cetera. I think in the situations where family dynamics are great and relationships are good and there's a lot of trust between the parties, then you can probably get away with, so to speak, the cheaper option of informal trust or even a for account, something like that. But when there isn't that full level of trust, then you probably want something that has a little bit more legal backbone to it.
For sure. But of course, consider the costs involved.
Absolutely.
So I think the takeaway from today's episode on trusts, if we can summarize it, is there's lots of vehicles that you can set up to protect against bad actors, taxation, probate, really having to provide better advice for family members. They do come with costs, of course. And, you really have to discuss it with your portfolio manager to see what's right for you. We've seen for our clients, all different ranges and types of accounts that are set up, formal or informal. And, of course, we didn't even talk about how you manage them, maybe in another episode, because you brought up, these trusts it's possible that money in the trust is actually taxed at a higher rate. You do get the benefit of putting it in there and there's benefit there, but there are cons to every single vehicle. There's no perfect solution for everybody in financial planning. Anything else you want to add?
No, I think we covered it. It's a lot of moving parts here, a lot of different options based on what your goals are and objectives are. Certainly, especially if you have a more complicated situation, you want to get a lawyer, get some legal advice and accounting advice, but definitely something that we can talk about when people have questions. And
it's very, very important. That's why we love to meet with our clients regularly, at least once a year, to discuss life changes. And it's a two-sided relationship. Obviously, you must let your portfolio manager, your advisor, know what you're thinking and talk it out and go from there. There's a solution to your problem in some type of vehicle.
And I'll jump in there just for one more topic to take us back to the first episode when we talked about the FHSA, another good option for saving for kids or grandkids that are age of majority, and you're okay giving them the money directly. Great option for young teens or people in their early 20s that it's a great option to help them buy a house and do very tax efficiently.
So we're going to leave this episode on a cliffhanger because we'll talk about next time the tax-free savings account, why we love it so much, and why we think it's really an underutilized tool.
Yeah, it was something that kind of started out a little bit, felt like peanuts maybe. Yeah. But nowadays, even if you have nothing in there, you can get close to $100,000 on day one. That presumably will keep going up. And we have clients who have been diligent and maxed it out every year that have probably close to $300,000 in there now.
Yeah, and our next edition, we'll talk about what people are using the TFSAs for, the great advantages for them. So that's it. That's all we have for you this week. We'll see you back here real soon.
Thank you.